break it down with Matt Roddy from Rockland Trust. Matt, first of all, thanks for joining us yet again.
Thank you for having me.
So, the stock market isn't like off to the races. This sounds like really good news. I don't get it.
Yeah, I think the market was looking for something right around the number, a little bit more of a Goldilocks scenario, not too hot, not too cold. The 242 is bordering on a little too hot. It gives people a little bit of pause about what the Federal Reserve might do as far as interest rates. I don't think anybody thinks they're going to do anything in March, but it takes them from maybe one raise to maybe 2 or 3 raises, and that gets the market a little jittery.
So we're down 20 points in the Dow. Just for the average person, what does that mean? A lot of people don't know what you mean by Goldilocks and so on. So you mean that there's a little bit negative sentiment because some people think that interest rates are going to go up sooner and by more?
Yeah, I think that they think the jobs market's getting a little bit hot, the unemployment's getting low, the participation rate's picking up, and so they're a little bit worried about what the Fed might do. I mean, the Fed's in a bit of a tough spot. They're focused on, what we're doing domestically, but they also got to look overseas. They're not just the central bank for the United States, despite their title of that. They are the central bank for the globe, and the globe and what they do with raising rates puts some pressure on the overall market. The dollar could strengthen, could put pressure all over the emerging markets' liquidity. It could put pressure on corporate earnings. It could do a lot of things. So if they raise too quickly, it could really be a misstep. And usually bull markets and economic expansions don't end of old age. They usually end because of a misstep in monetary policy or fiscal policy, and people get nervous when they have to go through change there.
So a lot of people at home have heard the headlines or seen the headlines that people thinking maybe a recession would come into the U.S. I mean, with these numbers, it seems very, very unlikely.
I put the odds very unlikely. I think that, I think if anything, I think we're going to maybe pull the rest of the globe kind of out of their doldrums. The dollar has been strong. That means their currency's weak. They are going to get their house in order with some of the monetary stimulus they've been doing. And then you add to that their currency's being weaker, their goods are cheaper, their labor's cheaper, and we're starting to see that. The emerging markets are starting to behave better. The developed markets are starting to behave better. So I think that, I think if anything, we're going to maybe pull them along, not have them pull us down.
It's been like a roller coaster in the markets. It just has felt awful for a lot of people who depend on maybe fixed income from dividends or whatever. What are your clients doing now with their money? Are they still investing strong in the stock market?
Yeah, well, I mean, candidly, every investor that we work with, we have a little bit of a customization to it. But what I would tell people to do, what they need to do, is they have to understand what risks they're willing to take. And then they need to allocate their portfolio to that level of risk and then rebalance back to it regularly. I think a lot of investors, a lot of times, are focused more on nominal returns. So in the 80s and 90s, when we were in that Goldilocks economy, people were getting 10% plus on stocks. They were getting high single digits on bonds. But inflation was 3 to 6%. Now inflation is running at less than 2% for the last 5 years. So 5 to 6, 7% return in the stock market like we've been getting, not every year, but on average, that's kind of the new 10%, and a low single-digit bond portfolio, 3 to 4%, is the new 5 to 6% that you used to get. You factor in inflation being lower, you factor in tax rates being lower, and that makes a real return to the investor about the same spread. And that's how you get to your long-term goals. If you don't want to take any risk at all, you can invest in cash, and cash is fine. But if you do that, you're going to need to save a lot more, because you are going to be losing, you might not be losing sleep, but you're going to be losing money to inflation and taxes.
Because it's not growing. All right, Matt Roddy from Rockland Trust, we appreciate the insight.
Good to see you.
All right, good to see you, bud.